Hey there, and welcome. Today, we're going to dive into one of the most crucial skills for any investor, and that is how to really research a company. Think of this as your personal toolkit for building some serious confidence in your investment decisions. So, let's get right into it.
This is the million-dollar question, isn't it? You hear all the buzz about a company, you see its stock price jumping all over the place, but how do you know what's actually real and what's just, noise? Trying to sift through all that information can feel totally overwhelming. But it really doesn't have to be.
See, the secret is having a system. So for today, we're going to become company detectives. And this 5-step framework right here, this is our investigative roadmap. It's a clear, repeatable process that's going to take us from just a vague idea about a company all the way to a truly informed decision. Okay, first things first. Before you even think about looking at a single number or a chart, you have to understand the story of the business. I mean, any good detective starts by learning the background of the case, right? And for us, that means getting to the absolute core of what a company actually does. It sounds almost too simple, but you would be shocked at how many people skip this step. Here's the rule. If you can't explain what a company does and how it makes money in just a couple of simple sentences, you're just not ready to invest in it. This is your foundation. Everything builds on this.
So to really get it, we need to get specific, and that means answering 4 key questions. What are they actually selling? What makes them special? What's their moat that protects them? Are they playing in a field that's growing, or is it shrinking? And this is a big one. Who's running the show? Answering these questions gives you the context for literally everything else we're about to look at.
All right, so once we've got the story down, it is time to find the hard evidence. We're shifting from the qualitative to the quantitative, and we're going to do that by digging into the company's financial statements. This is where the story gets tested against the cold, hard facts.
And the good news here is you don't need to be a CPA to do this. Your whole investigation is going to focus on 3 main documents. Just think of these as the big 3. They'll tell you almost everything you need to know about a company's financial health.
First up is the income statement. The easiest way to think about this is like the company's report card for a quarter or a year. It takes all the money that came in the door, that's the revenue, subtracts all the costs of doing business, and it tells you the bottom line. Did the company actually make a profit? It's your most direct look at performance.
Next, we've got the balance sheet. Now, if the income statement is like a video showing performance over time, the balance sheet is more like a photograph. It gives you a snapshot of what a company owns, its assets, and what it owes, its liabilities, on one specific day. This simple picture really shows you the overall financial stability of the business. And finally, the cash flow statement. And this one is so important because profits can sometimes be misleading. But you know what they say? Cash is king. This statement literally follows the real cash moving in and out of the company. A business that generates a lot of cash is like a person with a healthy bank account. It's a sure sign of real financial strength.
So now we've got the raw data from those financial statements. It's time for our next step, which is turning that data into actual insight. We need to analyze how well the company is really performing and, just as important, what could possibly go wrong.
The way we do this is by moving beyond the raw dollar figures and looking at key ratios. Ratios are like your secret weapon here because they put all those big numbers into context. They let you measure performance consistently and compare a company to how it did in the past or even to its biggest competitors.
So which one should you focus on? Well, for performance, return on equity, or ROE, is a huge one. It basically tells you how good the management is at using your money, the shareholders' money, to make more money. And then there's net margin, which shows you what percentage of every dollar in sales the company actually gets to keep as profit. A high net margin? That's the sign of a really efficient business.
Now let's talk about the other side of the coin. Because look, no investment is a sure thing. A massive part of your job as a company detective is to be a little paranoid, to proactively find the potential risks. You have to ask, what could completely derail this company's story? And we can put these into a few buckets. For example, is the company way too dependent on just one customer? Boom, that's concentration risk. Are a bunch of powerful new competitors about to jump into their market? That's competition risk. Or could a new technology come along and make their entire business obsolete? Yep, that's disruption risk. Finding these is every bit as important as finding the company's strengths. Okay, we've understood the business, we've checked the numbers, we've analyzed the performance and the risks. Now we arrive at the final analytical step, valuation. This whole thing boils down to answering one simple but absolutely critical question. Is the stock trading at a fair price today? See, a fantastic company can still be a terrible investment if you overpay for it. Valuation ratios help us figure this out. The classic is the PE ratio, which compares the stock price to the company's earnings. Another really powerful one is price to free cash flow, which compares the price to that hard cash we were just talking about. These ratios help you get a sense of whether a stock is cheap or expensive.
And there you have it. That's the whole shebang. You start with the story, you back it up with the numbers, you analyze its performance and its risks, and then you figure out if the price makes sense. That is your complete research framework.
You know, investing without doing this basic work isn't really investing. It's just speculating. It's gambling. And frankly, if you haven't done at least this much work, you just don't know enough to be making a decision. This framework isn't a nice to have. It's really the bare minimum for making a confident, informed choice.
So now, you have the roadmap. You are officially a company detective. You've got the key questions to ask, and you know what clues to look for. So the only question left is, which company's story are you going to investigate first? Thanks so much for tuning in.